Over the last few years, the best performing sector has been these FAANG stocks, or these large digital media companies, be it an Amazon, be it a Netflix, be it a Microsoft, be it an Alphabet, or I refer to it as Google, its main product. So what am I getting with Google? I'm paying 14 times for a monopoly advertising business that's grown at 10% per annum, and I'm getting for free number one in YouTube or online streaming media. I'm getting number one in automated cars. I'm getting number one in maps, and I'm getting number three in cloud. And if you look at all of those businesses, they're starting to monetize. So what does that mean? It means they're starting to generate revenue from those pieces. It comes down to valuation. So when we look at Google, Google trades on a 20 PE, but it's got 20% of its market share in cash, so about $110 billion. So as an owner-operator or a private equity style investor, when we buy that business, we're not paying 20 times for it, we're paying 16. In other words, if we bought the company in totality, that $110 billion would go back into our pocket. When I compare that to Amazon, it's got a 55 PE. It's got 5% cash on its balance sheet. So to justify owning Amazon, I have to believe that their cloud business continues to grow at 25 to 40% per annum to justify that price. If you look at Google, over the last 5 or 7 years, they've spent on average billions and billions of dollars on these other bets, which works out to be about 10% of their earnings. These other bets have been loss-making. The other bets have included balloons in the sky to provide internet, cable assets. There was a new CFO, ex-Morgan Stanley, Ruth is her name. She came over about 2 years ago, and her focus has been to make those other bets profitable. So if we give her credit and we say, you're just going to make them not break even, not profitable, but just break even. The PE, or price to earnings ratio of Google, isn't that 16 times anymore, it's 14 times. So I would say to you, would you buy a near monopoly advertising asset that's been growing at more than 10% per annum for 14 times? We would say yes. A new addition to the portfolio has been Facebook. We've all heard of the privacy issues that Facebook has had. This has given us an opportunity for the stock price to be derated. Facebook is the number 2 in online advertising, following Google, but it's the number 1 in apps. We look at their business, and they have spent over the last couple of years, due to these privacy issues, a significant step up in costs. But we believe that is coming to an end as they automate and introduce a lot of AI into that cost base to get rid of the bad actors from their apps. Also, they've spent a lot of money on capital expenditure building out data centres over the last couple of years. Again, we believe that is at an end. So from our point of view, we're buying a number 1 in apps business, we're buying a number 2 in global online advertising, we have a cost base that will be declining, the free cash flow will be used to buy back shares, and we have a management team that are the largest shareholders of the business. Their interests are aligned with ours.